Today's mini lecture is about sources of capital for entrepreneurial ventures. In other words, how do we raise money to start our business? Okay, this slide shows us the different sources of capital available. And probably the most popular, of course, is our own pockets. If you're an entrepreneur, you're starting a small business, you might decide, well, I think I've got enough money from my savings and I'll use that to start my business. But more commonly for many small businesses, it's also the family and friends who might join in and either lend you money or become a part owner of your company, and you start that venture together. Then we'll introduce to you a little later angel investors. So these are, again, wealthy individuals, perhaps, willing to put in some money to start your business. Another thing we'll discuss a little later are more formal investors called venture capitalists, and also banks who probably provide you with some debt financing. And then lastly, we'll also look at initial public offerings, where you can raise further funds by making your company a public company and selling shares of stock. Okay, so as mentioned, you can actually either fund your venture either by debt or by equity. So those are the two basic approaches. Debt financing is simply borrowing money. So you might need $100,000 to start your business, $100,000 to basically buy your initial inventory, which you could use to sort of start selling your products. And one way to finance that is to borrow money from a bank, for example. And the bank, or it doesn't have to be a bank, it can be a financing institution or a person actually who decides to lend you some money. But usually this person or company will need interest, or will basically demand that you pay them a portion of that amortization, with a portion of that going into interest and a portion going to the capital itself. Another approach is equity financing. So in this particular case, you're looking for an institution or a person willing to give money in exchange for ownership interest in the venture, and in return for an unsecured investment in the firm. So if you approach a commercial bank, usually they'll want to lend you some money over a period of between 1 to 5 years, and usually that is secured by a collateral. So in other words, you could put up your home as a mortgage to borrow money based on that home, your asset. And if your business doesn't go well and you're unable to pay the bank back, then the bank actually has a recourse to basically run after your asset that you put up as collateral. So there are certain advantages to debt financing. And the first is you don't relinquish any ownership of the business. So the business becomes entirely yours and you still control it. There's no management influence from the outside. More borrowing allows for potentially greater return on equity. So because you haven't basically shared ownership with anyone, if your business goes very, very well, you basically keep that 100% of the profit that you've earned. Now, if the economic situation is, that the interest rates are quite low, like for example, this situation nowadays, our interest rates are quite low. It actually incentivizes business owners to borrow money to expand their business. And so basically, you don't have to be paying these interest rates, these high interest rates. And in fact, that's what the Reserve Bank often does, is they deliberately lower the interest rates to spur up the economy, because they're hoping that with low interest rates, business owners are borrowing more money to expand their business. Disadvantage, of course, of debt financing is that you have to pay monthly um, interest payments, and then therefore that could be a cash flow problem, because you might have a customer and he's bought some goods from you, but he's asking for 30 or 60 days before he pays you. Then you made the sale, your business is doing well, but you don't have the cash yet. But the bank will always insist that they be paid on a monthly basis. And then if your interest rates are quite high, then the bulk of your money is actually going to pay for this debt financing. The heavy use of debt can inhibit growth and development for your business because, again, of the interest rates and the interest payments that you're making. Another problem here could be it's good to be borrowing money now because interest rates are low, but that's not always the case in the coming years. That interest rate could actually go up in the future, in which case your business is saddled with all this debt and all these interest payments that you need to pay. On the other hand, equity financing means that you're looking for people to invest in your business, and there is no legal obligation for you, the entrepreneur, to repay the principal amount or pay any sort of interest in it. So the um, co-owner, the investor, actually is taking a risk. He's putting in some money, not knowing if he will actually get that money back. So they're taking a gamble basically in your business. Um, the problem is it requires sharing the ownership and the profits with the funding source. So a venture capitalist putting in some money will, of course, demand that he has a share of the profits of whatever you're making in your business. So the equity financing, though, is safer for you, the entrepreneur, because then you're not paying any interest. And if on the low side, so if let's say your business isn't doing as well as expected, then basically your profits will be lower, but also the payments to your co-investor, you won't have to pay them any interest, or in fact you might decide not to pay him anything because your profits are zero. The owner, however, must be willing to give up part of your ownership in return for funding. Another option is to go public. So in other words, form a corporation, a public corporation with shares of stock, which you can eventually sell to the public as your business gets better. Of course, this is a little more complicated. You need to follow the Corporations Act. The investments will be usually bigger. But it's also a great way to, when you offer an initial public offering, then it's also a great way as an owner for you to cash in on some of the ownership of your business, and also actually make some money from the creation of the business. So for example, Mark Zuckerberg, when he first started Facebook, it was a corporation, but he did not create an initial public offering until a few years ago. And when he did that, of course, he was able to sell some of his shares and earn a couple of $1 million in cash because of those shares that he sold. Okay, so another way you could raise some funds is what we call crowdfunding. Seeking funding for a venture by raising monetary contributions from a large number of people. So you're not looking at venture capitalists, you're really looking at the general public, and you're asking them not to invest 1,000, 2,000, 500,000. You're just asking them to invest maybe a couple of $100 or maybe $10. And the more investors you have, even if they're paying you small amounts, then basically the bigger your funding will be. But of course, you're now dividing the ownership across thousands of people. Crowdfunding has two basic approaches or basic forms. The first is an informal rewards crowdfunding. And examples of these will be websites that offer this sort of service. Kickstarter.com, if you've got a business idea and you want some funding, you can put it up there, or like a project, and you need some funding for it. You can put it up on this website, and people willing to put in some money into your project, basically, they won't earn any cash back, but in fact, all they're getting is some type of a gift, or perhaps the product itself. So in other words, if I might be interested in a brand new invention that's out in the market, like an electric scooter or something like that, and I might plunk down some money, and all I'm getting in return is actually the product itself. When the product is created, by the way, that's one thing with crowdfunding is you might be putting in money and you're not necessarily getting your gift or your product back until the product has actually been developed. And therefore, you're in actuality, what the entrepreneur is trying to do is looking for initial customers willing to put in some money, knowing that they'll get the product that they purchased after maybe a year or even longer than that. So that's what we mean by rewards crowdfunding. Equity crowdfunding is actually sharing equity in the venture, especially in its early stages, in exchange for money. So this one is more formal. This really means that you are a co-owner of the business, in which case you may need, let me just pause that for a moment. You may need approval from the government, which there are regulatory bodies that basically make sure that your business, when you're selling shares of stock, that there is actually legitimacy in the business that you're creating. So usually there's a Securities Exchange Commission of some sort which approves your public offering or your shares of stock. So that kind of crowdfunding is, again, equity crowdfunding. And even the Australian government actually is promoting this sort of thing. And but again, you need to have government approval before you start selling your shares of stock to the public. Okay, so another form of sourcing, capital sourcing, is what we call angel financing. And the investors here are what we call angel investors. Angel investors are wealthy individuals who are looking for investment opportunities. And they're called angels because they're actually coming in at the moment where most investors are, because you're so new in your business. In many cases, you've not even started your business. These angel investors are willing to give you some money, very risky, of course, but they're willing to put down the money needed for your business to be established. So at this point in time, usually an angel investor is investing in an idea, and the business actually has not yet started. So typically, the money they put in will be 200,000 to 600,000 in investment, but they actually also demand a return that's usually quite high. It's usually 50% or higher in terms of a return on the investment they put in. So which means that if they give you $100,000, they're hoping to get back that 100,000 plus $50,000 in return for that investment that they've made. But once they do that, they become, again, co-owners, and they are taking a risk, and they actually have no legal recourse. Let's say if your business didn't do as expected, then that they can't necessarily sue you unless you didn't fulfill a promise that you made to them. So certain advantages to angel investors include, they don't necessarily invest in huge amounts. They prefer seed stage or startup stage when you haven't really invested, you haven't really created your business yet, and they're coming in to basically help you build that business from scratch. Angels exist in different industry sectors, and they basically are around to, if they're familiar with that industry, they're willing to invest in if you're operating in with that particular industry. And angels are genuinely interested in the entrepreneur. So one of the decisions they make before they invest is they have a look at you, the business owner, to see if you've got the experience and the personality to create that business and to make that business a sustainable operation. There are disadvantages, of course. Angels don't offer additional investment money. So they usually just give you one amount of money, and you can't go back to them to ask for more in the future because they usually have shallow pockets. In other words, they don't have that much money to invest in businesses like yourself. Angels lack important contacts for future leverage. So in other words, when you're getting a co-owner, you're hoping that that co-owner can help you develop, customer contacts, supplier contacts. But oftentimes angels are know nothing about that particular business you're in, and therefore may not be able to offer you those additional assistance. Angels also, because they plunk down some amount of money, they may insist that they have some control over the business decisions that you make. Angels are also getting more sophisticated in their investment decisions, so it's getting harder and harder for entrepreneurs to be shopping around for angel investors. Okay, venture capitalists are more formal. These are larger institutions. In fact, some venture capitalists may actually have a portfolio of other investors. And what they do is they promise a certain rate of return on whatever money is given to them by investors. And in turn, they go look around in the market for startup companies that they can invest in. They're usually quite powerful because they've got a lot of money to give, a lot of money to invest in. And what they do is they provide capital for startups and even during the expansion phase. So you could be an established business, but you need more money to grow your business. A venture capitalist may come in for a share of your business and therefore put in an investment. So venture capitalists are not necessarily silent investors. In other words, when they come in, they provide some assistance to help you. They can provide you with market research and in terms of, and also advice on your strategy. That you can consult with them in terms of the management needs that you might need. They can help you evaluate your actions, evaluate your proposals. They also have a lot of contacts in terms, including customers. They can provide you with customer lists. They can provide you with ideas on where you can find suppliers, etc. And some venture capitalists also give you assistance in negotiating agreements. So if you need to do a very technical agreement that needs a lot of legal assistance, they may already have within their company lawyers that can help you create these legal agreements. So this is the criteria for evaluating new venture proposals. So in other words, a venture capitalist before investing in your company will have a look at different things and make a decision before they plunk down money. And it's interesting to note that the financial consideration is actually way down the list. In other words, yes, they're after return on their investment, but more importantly, they're looking at your personality as the business owner. They're looking at your integrity. At the end of the day, they are investing not just on a company, they're actually investing in you, the business owner. There's a wonderful video on Moodle which I put up, and this is one of the required videos that you must watch to give you an idea on what a venture capitalist decides on and how he or she will make a decision on whether to invest in your company or not. And again, the number one thing is realizing that the entrepreneur is investing in you, the person, your personality, your experience, your passion for the business. Then only after that does he look at your product or the service that you're actually offering, whether it's a compelling sell, whether there is expectations that this market will grow and your business will grow with it. They also look at the societal trends. They look at the economic trends and to see whether your business fits in that. Will your business be supported by these societal or technological trends? So that's why we always say, we always ask you, have a look at the market, the environment, and see whether there's anything there that can actually support your market, because that's exactly what the venture capitalists are looking for. Somewhere near the bottom of the list, of course, is your return, their return on investment. They need to know that if they plunk down some money, there is a good chance that they'll get some return, above average return on their investment. They also have a look at their own team. They have a look at the team within the venture capitalist, the company there, and they'll see how well they can actually help you. Do they have any expertise that can expand your business? So if they have a big experience and a lot of contacts within your industry, then that's the kind of venture capitalist that you want, because then they can really put in some value added into your company. And again, you both the entrepreneur and the venture capitalist can expand that investment. So this slide just shows you the return on investment typically sought by venture capitalists. And it really depends on the stage of your business. If you're just starting your business and you haven't even operated yet, you're still basically researching your business. If you expect a venture capitalist to come in, the return on investment they're looking for is upwards of 60%. So again, if you're hoping that they'll put in $1 million into your business, they're seeking that after 1 year or 2 years, that 1 million will be grown to about 1.5 million. So the expected increase of their initial investment will become from 10 to 15 times their initial investment. And as your business proceeds and develops, when you finally established your business and the venture capitalist is coming in, you can see that the return that they're expecting will be a little bit lower than when you first, if you start asking them to come in when your business has not started. The reason for this is as your business develops, we're assuming that the risk is going down. When you start up your business, there's so many problems that can happen. The amount of risk is very, very big. And therefore, an investor will want a big return for the amount of risk that they're taking in. That's why many businesses, what they do is they don't seek venture capitalists until they're roughly in their second stage of financing, and when they've already established their business, so that they can show the venture capitalists that their business is already beginning to grow. And in that case, the venture capitalists, if they come in, they won't be asking for big returns on investment. And they basically, even the ownership stake that they'll be looking for will be much smaller than if they were asking you, if you would be asking them to come in at the start of your business. Okay, I'm showing you this slide because at the end of this term, you're going to have to create a business plan, and of course, present this business plan to your lecturer, me, in other words. And as a lecturer, I will be pretending that I'm a venture capitalist, and your job is to basically convince me to invest in your business. So, and I've highlighted the main points of what your business plan must have, your presentation. What your business plan presentation must have is basically You need to tell a full story and not just the first initial chapter of your business plan. You need to say, okay, this is how I'm going to start it, and this is how basically I'm going to grow the business, and how what's my vision at the end of, say, 2 or 3 years. So we're not just talking about the initial chapter, the introduction. We are talking about the entire business, and say over 10 years. The other thing that you must realize is when you're making that presentation, you're not necessarily promoting a product, you're promoting the entire company. Many companies begin with just one product, it's true. But if you don't have a vision to multiply your products, to come out with a new product in the next 5 years or so, or even less than that, then there is no growth potential in your company. And therefore, the investor, the venture capitalist, might say, well, it's a one product company. Maybe after 2 years, your growth will stop, and it's not worthwhile for me to be investing at this point. The other thing, of course, is the products that you will be thinking of should be compelling. Therefore, there is an actual market for the product that you're selling. There's this likelihood that there will be strong desire for the products and services that you'll be offering. And you have to show that in your presentation. You need to show the potential for rapid growth, and you need to show that you have a very strong knowledge of your industry. Because at the end of the day, if your venture capitalist knows more about your industry than you do, then it's an indication that basically you lack the background knowledge to um, expand your business. You need to, of course, show that you're familiar with your competition. You're familiar with the vision that you have for the business. Okay, there are a lot more things that are mentioned here, but I'll leave this up to you to basically read these elements. Okay, so we did mention that the venture capitalist is actually evaluating you, the entrepreneur. But remember, the venture capitalist is trying, or not trying, basically what you're trying to do is get that person or company to become a co-owner in your business. This means that you need to have a good relationship, or the potential to build a good relationship with whoever venture capitalist you're going to get for your business. They say that the relationship between a venture capitalist and an entrepreneur is like a marriage. And in fact, the relationship can last more than 10 years, which is longer than the average marriage, they say. So absolutely, you need to get to know the venture capitalist, and you don't just, especially when you've got a great idea, don't just extend your hand and wait for the money to come in. You want to be able to choose whether the venture capitalist is a good co-owner. Can you get along with this venture capitalist? So questions you can ask include, does the venture capital firm invest in your industry? In other words, is he or she familiar with your industry? Can he actually provide you with some advice? Do they have experience in that industry that you can tap for your own business? How much time will the partner spend with your company if you run into trouble? So, all companies expect that it won't be smooth sailing 100% of the time. Now, in case something unexpected happens, like the coronavirus, will your venture capitalists actually stick it out with you, or will they panic when times get bad? So many venture capitalists don't promise you, one-time infusion of capital. They usually tell you, okay, I will give you $100,000 every year for 5 years or something like that. So the problem with that is they plunk down 100,000 in the first year, but if the economy goes bad and they panic, will they pull the plug and say, sorry, I'm not going to pay you for the next, second, third, or fourth year? Which actually, of course, is not ideal for you. You want a venture capitalist that's basically bold and at the same time willing to take these risks, and also be flexible when times do get bad, and hopefully they have that same vision as you, the entrepreneur. So that's it for today's mini lecture. Um, so hope to see you again in the next couple of sessions.